Quick reminder, the 38% off coupon code on Building Your Wealth expires in 9 days. Take a look at that via the links down below. You can bundle up the programs if you want. You get lifetime access to the content. You get access to the private channels with stock buy, sell alerts in the Stocks and Psychology and Money group. And every program gets access to my private live streams where I can interact directly with you. Hey everyone, me Kevin here. Let's talk about what the Federal Reserve said today, Friday, March 5th. Now, we're not going to hear from Jerome Powell, but we do hear from two members of the Federal Reserve. These are very important members because they are presidents of individual banks of different branches within the Federal Reserve System, and they help Jerome make policy decisions. So let's take a listen to some of the things that they're talking about. Reuters put this article together, and it's really insightful. All right, so this is a chart of the 10-year Treasury yield, and then we're going to talk about what the Fed just said. But take a look at this. Let's go ahead and just draw on this for a moment here. This is really our pain began in the stock market right here. February 19th was really the last day that we had some good. It was a Friday, and then all of a sudden the stock market started selling off. And in part, it sold off because Treasury yields started rising. But this wasn't even that rough of a rise, this slope right here. Where things really got nasty was when the slope or the acceleration of the rate of the 10-year did this. I mean, look at that slope. That is fast. That is rapid. And so this is when we began having our sell-off. We had a little bit of recovery on Monday when bond yields were actually at a lower point, but bond yields started rising again throughout this week. And when Federal Reserve Chairman Jerome Powell talked and spooked the market yesterday, we got a big spike in bond yields here, and the stock market rapidly sold off. But I personally believe this relationship is going to begin to fall apart. Let me show you the relationship a little bit more clearly first, just by overlaying the S&P 500. And you could see the relationship gets weaker and weaker, at least in my opinion, you could see that. So let's take a look here. Let's draw where the relationship makes sense. So what do we see here? Right here in orange, we see the chart having a spike, and the S&P 500, or the SPY in this case, which is the blue line, plummets. We see that plummet there. It's really, really evident. Then look at this. I will erase this for a second. Let's go ahead and use a different color. Let's look at green. Look at this. The bond yields, there we go. Bond yields fall. And what immediately happens? Well, immediately, like what happens right afterwards? There you go. The S&P 500 goes back up, right? And we get this sort of like trading with, okay, when the bond yields go up, the stock market goes down. And this has kind of been training us to think, okay, all right, if we want to know what the stock market's going to do, just look at the 10-year Treasury yield. In my opinion, this is going to break. This relationship will not last much longer. And I think it's already started breaking today. Why do I think it started breaking today? Because take a look at this, folks. Watch this. This right here, and we know what the market did today. The market was insane today, okay? The market opened up today. It actually opened green. But by that's California time. By 11 a.m., the market started plummeting. So let's mark that for a second. The market started plummeting right here at 11 a.m. The market opened up at 6:30, which is actually right here. But wait a minute. This is when the 10-year Treasury was at its highest point, and this is when the 10-year Treasury was at its lowest point, which is very, very odd, especially since we rallied into the close. So we had our most pain when bond yields were in the day at their lowest point. Then we started rallying into the close, and we actually get bond yields going up into the close, right? So in my opinion, the 10-year Treasury yield as a relation to the stock market, I think that's already starting to fall apart. I don't think it's going to work very clearly again next week. Why did we have the big run up? Because of that rate, that acceleration was so fast. But now we got it. We're used to it. Okay, all right. The 10 years gonna go up over time. That happens. That's normal. That doesn't mean the stock market has to keep selling off. Well, what did the Fed say today? And this is interesting as well because it relates obviously to bonds. So, Neil Kashkari, the Minneapolis Federal Reserve Bank president, said the following, quote, "If we were seeing a real uptick in yields, that would give me pause. That would give me concern of the amount of accommodation we are providing to the economy and that the amount of accommodation we're providing is falling or it's reducing. And that maybe," he says, quote, "that might warrant us considering a policy response." they talk in tongue. So in English, he's saying, look, I see that the 10-year went up, but this isn't really like a big deal because look, if the 10-year is at 1.5 and inflation's at 1.5%, we really have a real return of 0%. And so we're actually not even seeing a real uptick in treasury yields. We're just seeing a quick uptick. That's kind of what the Fed is saying here. They're like, look, we're not seeing any cause for concern here. Yeah, sure, all of a sudden it ticked up really fast. I mean, the 5-year treasury bond ticked up so fast last week that it ticked up at its fastest rate in 10 years. That shows you how quickly it ticked up. And that was one of the things that really spawned this panic. Instead, Neil Kashkari says, and this is a great Reuters piece here, we are not seeing much movement in real yields, but rather an increase in what bond investors are demanding for compensation to reflect rising inflation expectations. Again, fancy tongue. Simplify this. Okay, so bond yields accelerate up. The Fed's like, okay, well, real yields are still low. So why is the Fed not doing anything? Well, because the Fed's saying, well, because real yields are still really low. And remember, real is what the yield is, 1.5%, minus inflation, which if that's around 1.5%, you're at zero. So real rate of return is zero. Nominal would mean you're not considering inflation. Anyway, so you've got Neil Kashkari going, look, dude, this is no big deal. Like, we're the Fed, and we're trying to get people to expect 2% inflation. Obviously, in the course of our business of trying to get people to expect 2% inflation coming, at some point, bond investors are going to go, well, damn, if everybody's going to start expecting 2% inflation coming, I better start asking for more money on my bonds. I better start asking for a bigger yield on my bonds. Like, why would I take a bond at 1.2% if everybody's expecting 2% inflation? Well, hell, give me 1.6%, otherwise I ain't buying. It's kind of what's happening here. And the Fed is like, everything's actually kind of going according to plan. Just because the stock market freaked out because bond yields went up a little too fast for you all little paper handers, that's not our problem. I'm obviously heavily oversimplifying the Federal Reserve here. But again, when you listen to them, they speak in like this foreign language. It's bizarre. Let's see if they simplify their language at all. All right, Kashkari said Friday that the new framework is helping push inflation up and providing the kind of accommodation that we hoped it would. Yeah, no, still foreign language. But basically, that is exactly what I just explained. Like, what's happening is what the Fed wanted to happen. They want inflation expectations to go up to 2%. The Fed's basically taking credit for what's happening. They're flipping the script. Here we are, like stock market tanks, and everybody's like, where's the Fed to say? Sorry, Thor came back and took his hammer. I'll get that back later. Anyway, so this is basically the Fed responding like, dude, this is what we expected. So no, we're not going to bail you out, you paper handers. Anyway, then we switch to a different president. St. Louis Fed President James Bullard. In an interview on Sirius XM radio, he said, quote, "It's not matching up right now that we need to be more dovish than we already are." In other words, again, in plain English, he's saying, yo, look, we're already telling you the economy is in doldrums and we're going to keep printing money and we're going to be at a, 0% rate for until at least 2023. I mean, we've told you that 17 times and we think that we might even keep rates low until 2024. We don't know how many more times and in different ways we can tell you that. But just because y'all paper handers are sad the stock market's going down doesn't mean that we need to start printing more money. That's pretty much what James Bullard is saying. And so when James was asked, well, what about Operation Twist? Can't you just do Operation Twist and start buying longer-term bonds? Because if you start buying the 10-year and the 20-year or the 30-year bonds, what's going to happen? You drive those yields down and you push yields down. Well, that's going to be good for the stock market, right? Bullard goes, dude, folks, the interest rate or the yield on the 10-year is 1.55%. If you look at the 6 months before the pandemic, that's pretty much consistent to what the yields were before the pandemic. And those are still pretty dang low historically. And the stock market did fine then. Again, not our problem that there's a little bit of a hissy fit going on right now. And quite frankly, you gotta give it to him. He's not wrong. If I put up the 5-year chart right here, this is the 5-year chart of the 10-year treasury yields, we're, right before the pandemic, we were like 1.8. We had a period here of 1.5 to 1.6 in October of 2019. In August of 2019, we bounced around. In November of 2019, we were like 1.7. Right before the pandemic, 1.78. And he's like, dude, 1.566, like, the stock market was doing amazing over here. The stock market was doing fine over here, with the exception of the end of 2018, like right around here. And this is where the Fed's like, okay, we'll stop raising rates. And that kind of led to that, stock market like, okay. But that's different, right? That's the Federal Reserve's discount rate. And we don't want to overcomplicate things here. The bottom line that we want to take away from Mr. Bullard here is Mr. Bullard is saying, guys, chill. Long term, this is not a big deal, 1.55%. Bullard goes on to say the following, that he would be concerned by disorderly behavior in the Treasury market. Something panicky would catch my attention, but we're not at that point. Mr. Bullard was then also asked about the stimulus package, and he said that he is skeptical that such a $1.9 trillion package would even get enacted. He thinks there's only a 50% chance of the stimulus package getting enacted. Now, I'm at like 80 to 90% of it happening. I'm maybe more bullish than obviously he is, but let's stick to the Fed right here, not stimulus. So, sticking to the Fed, we didn't hear from Jay Powell today. He's probably, half a fifth deep, okay? Okay, I shouldn't say that. But when we listen to Neil Kashkari and we listen to Mr. Bullard, what do we get? We get a reiteration that what's actually happening in the market is pretty much engineered by the Fed. Maybe the Fed is just retroactively taking credit, like, see, we designed this. Like, everything is fine. But keep in mind, the Fed's job is not to pump the stock market, even though it feels like that's exactly what the Federal Reserve has been doing since March. That's not their problem. They don't care if stocks go down or up. They care if the monetary system start breaking, if banks stop lending, credit cards freeze up, auto loans stop happening. That freaks them out. That is a danger. We're not seeing that danger is what they're saying. And so they're saying we have no motivation right now to change anything that we're doing because what's happening is not a problem. And now if we Jen Psaki circle back to the beginning of the video where I talk about we're already starting to see this fall apart of this correlation between bond yield up, stocks down, in my opinion, it's entirely possible that next week it doesn't make sense anymore. The charts don't inverse anymore. And the yield's not going to matter that much anymore. I think next week, the stock market's going to be in this position of, all right, let's now assess the damage. The hurricane happened the last 2 weeks. Let's assess the damage. Is something still overvalued? Sell it. Is something cheap? Let's buy it. And we'll see how the market reacts next week. So those are my updates for you from the Federal Reserve and on bonds. Hopefully this was helpful. If you found it helpful, consider sharing the video. And folks, we will see you in the next one.